The stocks are up and so am I. Oh, yeah. Today, guys, we're talking all things stonks. And if you don't get the meme, that's probably for the best. You will judge me if you do. Okay, so what are stocks? All right, stocks are just equity, okay? Now, some of y'all are like, oh, great. Well, I don't know what stocks are. I don't know what equity is. You're just talking gibberish, and I'm not following. Don't worry about it. I know the educational system is absolute garbage, and they don't teach you anything these days, so we'll take it from the top, all right? You're not alone. In fact, unfortunately, most people, they're in the dark, and that's a real shame, because you need these things, okay? They're not as good as they once were. I'm more of a crypto man these days myself, but I've made a lot of money in stocks over the years, and maybe a little advice about how they work, at least, can be helpful to you. All right. So, stocks, equity, shares, units in a company, they're all different words. Some of it is just reflecting of the particular type of company. Like an LLC has units, a corporation has shares. Honestly, there's not that big of a difference. It's just linguistics and some technicalities that honestly you don't care about and it doesn't matter. It's just saying I own a piece of this enterprise, okay? And so, when you get a big company, all right, something that's listed on the stock exchange, you know, the New York Stock Exchange, the NASDAQ, and any of the others, what happens is they take the company that's owned by private people and they do what's called an initial public offering. So now these shares that they've been able to trade back and forth between themselves and it's really hard to transact, they're now public, okay? They're on the stock market. And most people, when they're talking about stock, they're talking about stocks on the stock market, where you can go and buy and sell any publicly traded company. Now, why would you want to do this? Well, you're owning a company. The whole point of a company is to generate revenue. Most companies, I should say. Honestly, I'm seeing a bunch of really dumb ones these days, like Beyond Meat and other stuff. It's like, do you really know how making money works? But hey, I'm not throwing shade. Okay, yeah, I am. They're terrible. A bunch of these companies are just making no sense. But that's okay. That's okay. You're allowed to not make sense. You're allowed to lose money. I don't like it when people lose money, but they're allowed to. So, why do these stocks have a lot of value? Well, a lot of them don't. But the ones that do have value because they have a good underlying company. All right, let's take Coca-Cola, for example. It may not be the healthiest thing for you, but man, their drinks fall off the shelves. They serve millions and millions and millions of ounces every quarter to people all over the world. We can't stop consuming this stuff, even if we don't know we're consuming it. You'd be surprised at what all they actually own that you probably consume on the daily. Now, Coca-Cola, steady revenue, nice growth. I mean, it's iconic. More people recognize their logo than recognize a cross, which is just mind-blowing to me. But, you know, like it is out there. It is widely known. That has tremendous value. But what has more value is their cash flow, okay? They bring in staggering amounts, billions and billions and billions of dollars. And you know what? They pay it out. They pay out a large portion of their income in what's called a dividend. Now, how dividends work is they make income, they pay it out, and they pay it on a per share basis, okay? So every quarter, or at least every quarter that they're offering a dividend, they'll be like, hey, we're announcing a 20 or 40 or however many cent per share dividend. And, you know, it can be any amount, really, as long as they actually have to pay. And then the money is paid, it goes to your brokerage accounts, and then your brokerage accounts pays it out per share. So if you have one share and they say 25 cents per share, cool. You're getting 25 cents. Now, if you got millions and millions of shares, it's a whole lot more than that because, you know, 25 cents per share, 25 million cents. That's tasty right there. But, or at least it would be if inflation wasn't so incredibly high. Honestly, you can barely buy a few bottles of Coke for that these days, but that's okay. That's okay. Luckily, companies keep up with inflation because they have pricing power typically. But all a stock is, usually, there are special kinds, of course, is the ability to control that percentage ownership of a company. You have the right for your voice to be heard because you can cast a vote, unless it's a non-voting share like a bunch of tech companies like to issue. But, you know, traditionally, one share, one vote. You can look at Instagram, Facebook, or Meta now, Google. Almost every big company you've ever heard of, though, they don't seem to like the whole one share, one vote thing. Many of them have structured their shares in unique ways. See, you can have multiple kinds of shares. Now, most companies, they just have one share type, and it's like all shares created equal, blah, 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 equal equity ownership, equal percentage of profits rights, equal voting power. But you can actually have multiple classes of shares, they're called, okay? A lot of them have A, B, and C. Now, maybe for A, you have, one vote. It's an equal percentage of profits relative to the rest of the shares, okay? And maybe Class B has 10 votes and an equal value of profits distributed to them. And you can even have it to where maybe C has 0 votes whatsoever. And maybe they have equal profits. Or maybe they have a very slightly higher percentage of the profits allocated to them. This is almost never the case. It's usually you get the same profit and no vote because we don't like democracy. And you know what? Okay, whatever. It's your company. You do with it what you will. But most of the time, it's one share, one vote. They're all the same. You all get the dividends. Now, some of you may have been like, hey, I've heard of preferred shares. What are those things? Okay, preferred shares, well, they're the elite snobs in the room. They think they deserve to get paid first. And they do. Okay? And they give up some stuff for it. So, preferred shares are just a type of share that if dividends are being distributed, they have first dibs. They have to be paid first. So if you're going to pay the common stockholders, that's what the normal shares are called, the common shares. If you're going to pay them a dividend, these guys get one first, okay? And if you're not giving them one, maybe these guys still get one, okay? If anybody's getting a dividend, it's these guys. And if they're not getting one, the common share guys cannot get one, okay? It's just not going to happen. Now, not every company has preferred shares. In fact, an enormous amount of them don't. In fact, most of my companies don't have preferred shares. But there's valuable reasons to have them, okay? Sometimes a company wants to grow and they don't want to issue new shares and dilute their equity, but they don't need to get debt. Maybe debt's really expensive right now. Maybe there's other things that make it complicated for them to get debt. So what they can do is they can offer preferred shares. These preferred shares may come with, say, a coupon. Let's say they're a 8% preferred share. So your dividend, when we're paying it, is 8%. That's a juicy dividend. A lot of dividends are only like 3, 4, 2% even. And so it might come with a pretty significant dividend. And the company may otherwise not even pay a dividend. Or it may be 1% for the normal common stock, but 8% for the preferred. That's pretty good. Now, it's not a free lunch. Usually, almost always, preferred shares don't get a vote, which is fine. They're forgoing that right in order to get compensated. They also get a few other benefits. So let's say things aren't working out and the company is going bankrupt. Well, they have what's called a liquidation preference. So in the order of assets getting sold off and people getting paid out, they fall below everyone who has debt, secured debt, any of the debts and stuff, secured collateral, blah, blah, blah. But when you start getting down to the equity components, they're above common shareholders. So if there's anything left after they've paid off all their debts and all, these guys might get something, which almost always ensures that the common shareholders get nothing, but like they probably weren't getting anything anyway. That's why they're in bankruptcy. This is not exactly the greatest perk on earth, but sometimes it can be useful. Sometimes if a company is going bankrupt, you can find preferred shares that are trading for absolutely nothing hardly. But maybe there's going to be a little bit of cash that gets left over and dispersed to them. So sometimes you're able to find a cool little arbitrage trade on these things. Now, not always, obviously. You got to do a whole bunch of due diligence. The timing's got to be right. It's a tricky little thing to pull off, but sometimes you can, and you can make a great return on it. But there's other kinds of features these things also have. So we've been talking about it as if all preferred shares are the exact same. They're not, okay? The lie that all things are equal, it's a lie, okay? No, you got different options, effectively, that can be attached to these things. So they can be what's called callable or convertible, okay? So these shares that are preferred shares, they can actually convert into common stock and it'll usually have a ratio or a certain price they're allowed to convert at. And so usually that price or the conversion amount is very different than what the current thing is. So the value of the company has to go up significantly for it to do that. Now, sometimes if they're being, issued in a distressed manner or for particular reasons, they might actually be roughly 1-to-1, in which case it's a really good deal. Like that's a pretty interesting way to own some equity in the thing without equity, because if it goes up, your position goes up by a similar amount because the value of your thing can be converted into the underlying equity. Or you can just keep collecting your cash if it's collectible. Now, of course, they don't have to pay a dividend, but there's a second feature that really, really, really improves your payout ratios and payout over time. All right? It's called cumulative. Oh, I love cumulative preferred shares, okay? So, they don't always have to issue a dividend to common or preferred shares, but cumulative preferred shares, say that 8% we mentioned earlier, say they're not offering a dividend right now. But if it's a cumulative, when they want to issue dividends in the future, for however long they haven't been issuing you a dividend, from the time they last gave you one till now, whatever rate is the face coupon on those preferred shares, they owe that amount. All of it that you would have gotten if dividends had been paid. And they have to pay you that before they can pay any dividends to common shareholders. So cumulative preferred shares are delicious. If you can find them and if they ever pay a dividend out. Some of them may never. So, just because it says cumulative on it doesn't mean you just found a cash cow. But in certain situations, it can be very, very nice to have. We've talked a whole lot about the different kinds of preferred shares, and now you have a basic understanding of normal stocks. But what happens when stocks go up? Well, it's real simple. You have a few different options, but most people just sell. What happens when you sell a stock? You get a little bit of capital gains, hopefully. Now, the reason people are so interested in stocks and stuff is because when you sell it and you have these capital gains, they're taxed like capital gains, which is taxed at a much lower income level than your ordinary income, or at least for those of us who make some decent money. If your income's nothing, okay, you're not really getting taxed. But once you start making some real bucks, you're up there almost at half of your income getting taxed away on your ordinary income, which is just absurd. Capital gains tax is like 20%, okay? Much, much, much less. Still way too much. I would argue it should be legal to charge more than 10% on any kind of tax, but you do get taxed less on this. And so this is another reason that stocks can be very, very appealing to people. Now, there is just one problem, honestly, with stocks. Other than the fact that you have to do your due diligence, you might pick a bad company, and all these other things. Honestly, the government's been printing so much money, and people have been buying so many stocks over the years, the valuations of the average company, they're just too high. They're so high that if you buy them based on their cash flow, it's just a bad deal, okay? The previous generations were picking stuff up at under 15 times price to earnings. That's just the valuation you have to pay for every dollar of earnings, effectively. Right now, it's perfectly normal to see 20, 30, 40, 50. Name a big tech stock, they're all trading 30 to 50 times earnings. I hate to tell you guys, but buying those is, it's not, they're good companies, but they have to grow the size of countries in order for you to start getting a good cash flow rate of return. That's why you'll oftentimes find me in crypto, where sometimes the returns are just enormous. You want to find a way to earn a safe 20%? Just join the Overlord Club. You want to find a way to earn a nice little 30, 40%? Overlord Club's got real estate tokens that you can go take into DeFi. It's all real easy. And you know what? You're not going to find any company, not a single one, that you can get a 25, let alone 40% cash flow to your pocket in dollars thing. It doesn't exist. The value of these assets have been bid way too high. Oh well, I'll stop doom and glooming. That's been stocks. Let me know if you have any questions in the comments. Let me know if there's anything else you want me to cover, okay? Maybe you want me to talk about how you can use stocks to do a hostile takeover. I do love me a good hostile takeover. They're 3 times better than friendly takeovers. And I have the math to prove it. I'll see you guys next time. Bye-bye.